All right, let's cut right to it. The market is sending you a completely false signal. While you see algorithms and the rest of the street chasing the latest AI hype, a massive, seismic shift is happening behind the scenes, in the dark pools. The smartest capital on Earth is quietly, methodically, rotating out of pixels and into something real, something tangible. They're moving into the one asset it is mathematically impossible to print more of: topsoil. Okay, first, our standard protocol. You know the drill. This is a quantitative analysis, it's for educational purposes only, and it is absolutely not financial advice. Every single type of investing carries a significant risk of loss, so please, always, do your own due diligence. So what are we really talking about here? The core of this whole thing is what I'm calling the Great Rotation. It's a massive capital flight from the digital world of software into the hard, cold reality of physical, productive assets. And the why now is what's absolutely critical. In a high inflation world, you don't want paper, you want production. Now look at this slide. This is where you see the huge divergence in strategy. On the left, you've got what retail is chasing: chatbots, pixels, digital mirages, things with a theoretically infinite supply. But on the right, that's where the smart money is going: topsoil, water rights, food production. Institutional capital is quietly cornering assets with a mathematically finite supply. They're literally swapping fleeting digital trends for enduring physical reality.
I'm going to state the core thesis one more time, because this is the alpha right here. Retail is buying chatbots, but the 1% are buying the only asset that is mathematically impossible to print more of: farmland.
And look, this isn't some abstract pie-in-the-sky theory. It's a brutal equation. The UN's Food and Agriculture Organization projects we will have to feed an additional 2 billion people by 2050. That is a massive, non-negotiable demand shock that's about to hit a system with a fixed, and I mean fixed, supply of productive land. And this picture right here, it perfectly illustrates the supply side of that equation. Arable land per person is not only finite, it's actually shrinking because of things like urbanization and soil degradation. Every single day, there is less of it. This isn't a stock you can just split, or some crypto token you can mint out of thin air. It is the literal ground beneath our feet, and it is disappearing. So the real question is, how do we actually verify this rotation is happening, right? Well, we cut through all the market chatter, all the noise, and we look directly at the institutional footprints in the data. We're going to dive into the historical performance and the current technical picture for the key proxies. Now, for anyone who's still clinging to the idea that equities are some kind of reliable inflation hedge, well, the data from the last major inflationary cycle says something very, very different. Just look at this chart. From 1973 to 1982, U.S. agriculture delivered average annual returns of 13.4%. That blew the S&P 500's 8.5% out of the water. They say history doesn't repeat, but it sure does rhyme. But here's the paradox. This is the trap where most traders get completely wiped out. You look at the daily technicals for a key proxy like Gladstone Land, ticker LAN, and the chart looks absolutely broken. The RSI, no buying momentum. The MACD, it's crossed bearishly. And the absolute killer, as you can see, it's trading below its 200-day moving average. So why on earth would big money be touching a chart that looks this weak? It's because they're operating on a totally different analytical layer. They're accumulating shares in dark pools. These are private exchanges where institutions trade massive blocks away from public eyes. So let's apply the translation layer here. In plain English, this means, as the world grows and the amount of farmable land disappears, Wall Street algorithms realize you can't eat software, so they are dumping paper assets to hoard the physical land that produces our food and fuel. That bearish-looking chart isn't weakness. It's the fingerprint of methodical institutional accumulation. Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. Okay, let's game this out. For a trade of this magnitude, you absolutely must have 3 potential futures mapped out in your head: the bull, the bear, and the black swan. Okay, the bull case? It's pretty straightforward, driven by macro fundamentals. Relentless global demand for calories and sticky inflation just send land values parabolic. The bear case is a rate-driven crisis. The Fed holds rates higher for longer, forcing these REITs to cut their dividends, which then sends their stock prices spiraling down to retest deep support levels. But the black swan? Now that's the scenario where things get biblical.
A systemic failure in global fertilizer production could literally render grade A topsoil the only functional global currency, with food as the ultimate collateral.
Look, mapping out scenarios is completely useless if you don't have a protocol to manage your risk. In an environment like this one, protecting your capital is job number one. It is the primary objective. You just cannot afford to let your capital sit around in stagnant paper assets while this real asset rotation accelerates.
This framework right here is non-negotiable. Step 1, position sizing. You have to optimize it mathematically using the Kelly criterion, which tells you the ideal allocation size to maximize long-term growth. Second, profit defense. We do this algorithmically using dynamic ATR-based trailing stops. ATR is average true range, a measure of volatility, which lets your winners run while you systematically cut your losers short. And third, the absolute ironclad rule of entry discipline. You do not deploy capital into an asset that is trading below its 200-day moving average, period. You wait for the trend to confirm its strength.
All right, let's talk execution. To play this theme in the public markets, the whole analysis really comes down to two primary REITs, Gladstone Land, ticker LAND, and Farmland Partners, ticker FPI. This is the topsoil arbitrage.
So let's put the data on the screen and run a little head-to-head. Right off the bat, Farmland Partners, FPI, is way more profitable, boasting a 60% net margin versus just 15% for dollar land. It's also got a higher return on equity and a lower beta, which just means less volatility against the broader market. But dollar land offers a much higher dividend yield at 5.4%. So the arbitrage really is a choice. Do you want FPI's operational efficiency and lower volatility, or do you want land's superior cash flow yield?
I'm going to leave you with one final question to frame your own analysis. In a world where central banks can literally print infinite currency out of thin air, what is the terminal value of a productive asset that they absolutely cannot?
Hey, if you got value from this data-driven breakdown, hit that like button and subscribe. I really want to see your analysis down in the comments. Are you targeting dollar land for that juicy yield, or do you prefer dollar FPI for the operational alpha? Drop your thesis below. Let's talk about it.